Assalamualaikum and a good day to everyone. Okay, today we're going to start chapter 5, book of prime entry. Okay, so the content of this chapter is, first you have to learn about the source document, know about your source document before making a journal entry, which you will also learn in this chapter, the journal format and types of journal, and lastly the types of ledger. Okay, so let's begin. Okay, starting with source document, which I will scroll through a few documents that will be generally used in your syllabus. You can find other documents in your chapter 5, page 32. Okay, so types of documents. Documents or source document are proof, evidence for each business transaction that has occurred for the specific date. Okay, as we all know, in accounting, if you want to record a transaction, you need source document, the evidence for that transaction. It provides objective and reliable evidence for useful information, and a recording process cannot occur without a source document, as it could be fraud or embezzlement. Okay, so source document is your evidence, proof of the existing transaction. So let's look through a few documents. So starting with purchase order, PO for short, it's a document offer issued by a buyer to a seller indicating types, quantity, and agreed price for product or service. So PO is your purchase order for your materials or for your stock. So you make a PO when you need to order new stock. Okay, so it's a buyer to a seller. So when you buy a stock, you will make a PO document. Delivery note, which is a document used to trace your delivery package. Okay, so this is an example of your delivery. Next is a cash bill. It is a document receipt of cash payment. Highlight with the statement of cash payment. Cash bill only records cash payment. Okay, moving on. We have an invoice. So an invoice is a document by a seller to a buyer relating to payment. Okay, so it usually relates to a credit payment. So when a payment needs to be made, an invoice will be created to attain those payment, which is usually by credit. So you can see from the sentence, the original credit purchase. So originally the payment was not made yet. So when you ask for the payment, it is use the invoice document. Okay, receipt document, which is your typical receipt. It is a payment made by cash or any other transactions such as by check or online banking. So usually have the product, the price, the taxes included in the document, just like any receipt that you receive when you make a payment for something that you buy. Okay, next, it's a debit note. So debit note is a document used by a seller to inform the buyer that they have been debited in the seller's account. So it is a reminder for the fund currently due. Okay, so meaning it's a debt for the buyer. Other than used by a seller to inform of a debt, it also can be used by a buyer to return a broken or mistaken stock that they just bought from the seller. So when the buyer wants to return back the stock that they just bought, they can also use a debit note. So next, check. It is a document that orders a bank to pay specific amount. So check is just used by the owner to draw out money or transfer out money in the bank. Credit note. It is a document by the seller to the buyer to inform that they have been credited in the seller's account, which means it's reduced in debt. Okay, so just like the credit note, just like the debit note, the credit note can also be used to inform of the return of goods or stock that was just bought. Okay, so they are used for sales return or return inward. Okay, so payment voucher, a document which can be used as a proof of monetary transaction that occurs between two parties. Okay, so payment voucher is just a document used for evidence regarding payment. Okay, now so we go into our second content, which is the journal. Okay, so types of journal. So as you can see, there are many types of journal that has been categorized specifically. So starting with a general journal. Second is the purchase journal, which focus on purchase transaction. The third is sales journal, which focus on sales journal only, sales transaction only. The fourth is return outward journal. Fifth is return inwards journal. The sixth is cash receive journal. And the seventh is cash payment journal. Okay, so each transaction will be put into these 7 specific journal only. Okay, so when you start doing your transaction entries, you will put them into this journal. Okay, moving on, we will start with the general journal. Okay, so general journal are used to record sale or purchase of non-current asset. Okay. Okay, so you can see that non-current asset on credit. Remember that any transaction that is on credit for non-current asset, it is put in the general journal. Second is the correction of errors transaction. The opening and closing entry will be put in the general journal. Transfers, any transfers will be put in the general journal. Withdrawal of stocks for owners on use. So drawings is also put in the general journal. Lastly, adjustment. So these transactions are used and recorded under the general journal, which means they have no specific place other than those 7 classified journal. They will be put under the general journal. Okay, let's look at an example. So the example for general journal is on the 1st of January 2017, Ali purchased office furniture from ABC, RM 10,000 on credit. Okay, so we know that they bought the asset on credit. So the effect of this transaction is that they increase asset as well as increase liability because it is on credit. So this is the effect. For the entries, the transaction entries, we can debit the office furniture and you can credit your account payable of ABC. Okay, so this is the transaction entries which we'll put in this journal format. Okay, so you will put the debit side here, which is the office, and the credit side is the AP for the ABC. Okay, so debit and credit. So this is the format. So next type is the purchase journal, which means when you purchase your stock. or inventory. To record goods purchased on credit. Remember that it is on credit only. So when you purchase your stock on credit, it is put under the purchase journal. So the resource document is invoice received from supplier. So purchase journal example. On the April 1st, bought goods on credit from Abu RM100 invoice 123. So there is an invoice number which we'll put in this invoice column. Okay, when they give an invoice number. So the effect of this transaction is you bought goods. Okay, so you increase your expense and you increase your liability. Okay, the transaction would be debit purchase and credit AP from Abu. So AP Abu. So this is the transaction entries. So the only thing you will record is the Abu's the name of the seller, Abu's name, the invoice number 1, 2, 3, and the amount. Okay, so you can see down here, transfer to the purchase account, the total will be transferred into the ledger. Okay, so when you total up all the purchase transaction in this journal, you can transfer the total of those purchase to the ledger. Understand? Okay, next, it is the sales journal to record credit sale. Okay, specifically for sales transaction on credit only. So document used are invoice. So the example here is April 2 sold good on credit to XYZ RM200 invoice 222. So invoice number is given, thus will be put in the column suggested. So the effect would be increase your asset and increase your revenue. Okay, so the entries would be debit AR. Your AR is XYZ and credit sales. So because it is a sale. Okay, after you've done your debit and credit, you will put the transaction in the journal format as stated below. Particulars is your buyers, the invoice number, and the amount. Okay, so transfer to sales account, which is the total of the sales journal. You will transfer it into the ledger, same as the purchase journal. Okay, next, so return inward, return from a customer. Okay, so it's to record transaction involve goods returned by a customer. Source document are credit notes. Okay, it is a journal specifically for return made by a customer. Okay. Okay, example for return inward, which states April 10 goods returned by XYZ RM50 credit note 111. Okay, so XYZ, which is our customer, they made a return amounting RM50. So we know that when there's a return inward, the effect would be our, our effect would be decrease in revenue as well as decrease in asset because they return back our sales. So the transaction would be debit return inward and credit AR because it was made through credit transaction X, Y, Z. So after you identify the transaction, you will put them in this format, which with particulars, the name is our buyers, the credit note number if given, and the amount. So the total at the end of the month, you will transfer it into the ledger. Okay, so every day, every transaction specifically on return inward will put in one journal. Okay, return outward journal, which is a returns of goods to the supplier. Document used is debit note created by the buyer. So when they wanted to return back their purchase, they will give a debit note to the seller. Return outwards journal. Example is April 9th, good returns to Abu RM20 credit note 011. Okay, so we return back our purchase to Abu RM20. So the effect would be decrease in expense and decrease in liability. So we would debit our account payable Abu and credit return outward. Okay, so after you identify the entries, you record them in this format. The particulars would be our seller Abu and the credit note number and the amount. Okay, so the total at the end of the month would be transferred to the ledger. Moving on, the next journal is cash receive journal, to record all cash transaction from a source, from any source. So source document will be received and cash register summary among the example. So this journal is for cash receive only. So when you receive money, you attain money, you record it in this journal. So any form, any resource stated in this line would be, whether it's in cash, in bank, it will be recorded in this journal. So anything that you receive, okay? Let's look into cash receive journal. You can see that the example here, there are three types of transaction. First is April 25, receive RM150 check from XYZ, meaning it is a bank transaction. Second, April 27, receive RM200 cash from XYZ with a 5% discount. That is commission received by check RM450, which is also a bank transaction. Okay, so you record those transactions in this format. First is April 25. Detail is where did you receive the cash from. So you receive it from XYZ and recorded debit 150 under bank because you receive a bank transaction, and you credit it 150 under account received because XYZ was our buyer. Okay, so this is payment for buying. So you reduce the account payable because XYZ has made their payment. So the second is XYZ also with a cash 190 and a 10 ringgit for discount, which is the 5%, and account receivable. Okay, commission which you receive in bank transaction 450, and other account when you cannot put any specific names as the column stated. Okay, so in the column, the credit column, there's only AR and sales. So when the transaction is either AR or sales, you put it under other account here. So commission received is commission income. So there's no column for commission income, so you put it under other account. So lastly, in the last row, you can see the total at the end of the month, which will all be transferred into the ledger. All the total. You will transfer only the total. Next is cash payment. Opposite to the cash received, you only put the payment in this journal. Any cash payment from any resource. Just like the cash received. So the source document is payment voucher, check box, anything, any document that proves the existence of the payment. Okay, so example, you can see that there are also 3 types of transaction. The first is RM20 paid, April 20 paid RM180 to Abu. Check number is given. So when there's a check number, it is a bank transaction. Second is April 24 paid sundry expense by cash, 250. Lastly is paid Abu RM200 cash received 5% discount. Okay, so just like our cash receipt journal, the detail you will put where the resource of our payment is go through. So Abu was our supplier. We bought some stock from him, so you put Abu here and you credit the bank 180 and account payable 180. Okay, so you can see contradict to the before, the position of the debit and credit are different. So try to put the detail correctly. Okay, just like the expense here, you paid by cash, so you reduce your cash and other account, which means that cannot be classified in any column. So other account will put if it can be specified into AP or purchase. Lastly is Abu. You made a cash payment. You receive a discount and also reduce your account payable. The total will be transferred into the ledger. Okay, so that is all for our types of journal. So there's only 7 types of journal. You will put any entries into those 7 journals only. Okay, after you complete your journal, you will put the total N into a ledger. Okay, so the T ledger that you've learned in chapter 4, there's also 3 types of ledger. First being sales ledger, which is a ledger for account receivable individual account. So second is purchase ledger, which specifies for account payable. Lastly is general ledger, meaning any other ledger that you cannot classify into AR or AP. Okay, like drawings or cash and bank ledger that will be put under the general ledger. So AR and AP have their own section, while the other will be put under the general ledger. So if you have forgotten, your ledger format is this T account over here. Is there the T account? So this is your format for your ledger, which you will input the total only from the journal. Okay, total only. So that will be our flow from source document to journal to ledger. That is the end of chapter 5. Okay, thank you.